Welcome back. You're watching The Money Show on ET Now. We still have Mubina Kapasi with us because we have another topic that we'd like to discuss with her, and that is the Central Public Sector Enterprises Exchange Traded Fund, or basically the acronym of CPSE ETF. It may sound a little complicated, but to put it very simply, this ETF essentially invests in 12 public sector companies. So the likes of maybe a GAIL, NTPC, Coal India, the Jewels, the Maharatnas, what we call of India, all publicly owned companies is where the ETF invests in. So about 60% of the ETF, by the way, is in Power Grid Corporation, is in ONGC and in NTPC. The fund is being managed by the Nippon India Asset Management Company. Now the question, of course, that many of you may be having in your mind is, should you invest? Well, this is the 6th offer, and that is going to be opening on the 31st of January for retail investors. If you buy the fund, you can, sell it again on the exchanges because it's an exchange traded fund. So now, Mrin, I want to get in your opinion on this. What is your perspective of the CPSE ETF? If one gets a chance to actually invest in some of the golden jewels of India Inc., owned by the government, of course, public sector enterprises, should they do so?
Actually, no, because I think the fund is extremely concentrated towards the energy sector, the oil and the energy sector. As you mentioned, 3 stocks make up for 60% of the fund. And while, of course, it's an ETF and it's really low cost, if you look at the previous tranches, the previous tranches have not really done very well compared to the Sensex. So I would not really suggest to invest here. I mean, there are other diversified ETFs that are available which have exposure to various other sectors as well. So I would not suggest it, and certainly don't get into the fund just because there's that 3 or 5% discount that's available for a retail investor.
Mrin, that was literally going to be my next question, that you're getting it at a 3 or it's a 3% discount this time around, but you're still not exactly, for it. And also, there's a bonus of 1 unit for every 15 units that an investor buys. And of course, you've had to hold it for at least 1 year. So even then, you're saying that investors should not, sort of benefit from this discount?
I mean, more than anything else, it's like the fact that it's a very, very concentrated portfolio towards a particular sector. So I'm not sure how many investors, when they're investing in this fund, I'm not really sure whether, they're aware of this, or the fact that they actually want to take those sort of exposures in one particular sector. Honestly, among all these stocks, the best performing stocks, or the stocks or the companies that are expected to do well, would anyway be available in a multi-cap fund for sure. So I think, the concentrated nature of the portfolio is what I'm not in favor of.
Well, fair enough, because
irrespective of the discount or the bonus that's being given.
Yeah, that's true. And when you say concentrated, it's highly concentrated. In fact, energy and commodities, the highly cyclical sectors, is where this ETF has a big chunk of its money invested in it. It's a passive fund, of course. It's an ETF, so naturally it's a passive fund. So if an investor, let's say, does like the idea of, having a power grid in his portfolio, having an NTPC in his portfolio, since they are public sector units, would you recommend them? Would you recommend any other, fund out there? I mean, would you recommend that maybe a Nifty 50 index would be a better bet then?
Yeah, I would say that will be a better bet.
So why would I also go for an ETF, a CPSE ETF, when I also have the option of directly investing in a power grid, or directly investing in an NTPC? Since any which ways, I suppose these are extremely concentrated funds. I suppose it begets that question as well. I just had a quick question essentially on how exactly would you pitch this versus maybe even your regular active fund? Because when I look at it, it's a negative 6% return, like you were mentioning, that the fund has actually given as per some data from value research that I say 6% is the annual CAGR on a 1-year basis, 6.35 on a 3-year basis, and negative 2.59% on a 5-year basis. So obviously on the long term, maybe the CAGR is not that bad. So even from a long-term perspective, Mrin, you would say that you should just stay away?
Yeah, and as I said, because this oil sector or the energy concentration, the other bit being that, if these stocks are expected to do well, they would anyway be part of any multi-cap portfolio. So I don't see the need to basically get into a fund which has only 12 stocks basically, and take those sort of bets, not for retail investors certainly. If there's an investor who has a particular view on this particular sector, then he might want to take it to an extent in his portfolio. But I think, not for retail investors. As we've seen, either people are too over diversified or they're too under diversified, and buying this fund is certainly not going to help in diversification.
What about Mrin, if I'm being a little overly ambitious here, as in my capacity of, let's say, a retail investor? Do you think I should look for any sort of arbitrage opportunity, since we were just discussing arbitrage funds and you explained to us the concept so well? And since I'm getting this at a 3% discount, that's exactly the discount, by the way, 3% is what this FFO is priced at. Since I am getting this 3% discount, do you think that immediately after allotment, if I sell it in the market, I can make that quick buck? Or do you think that's best left to the qualified and the institutional buyers out there who do this literally for a living?
Yeah, I think it's really left to the institutional investors. And honestly, you should not be investing into an ETF if you're only looking at it as a listing gain, right? So you would want to look at it because you feel that this is. You would look at it because you find it to be a fit in the portfolio. And again, of course, being an equity fund, you need to have a long-term holding in this particular fund. So certainly, I would suggest, irrespective of the discount, I think there are many other funds which have got like good long-term history that are available for you to choose from, basically, rather than getting into this.
All right, fair enough. So Mrin's not exactly in favor of these ETFs. Whichever way you dissect it, whatever sort of benefits you put, she's saying it's best avoided. Okay, Mrin, before I let you go, I must ask you this question, because we're just 3 days away from the Union Budget 2020. And, as a personal finance advisor, for the benefit of you, for your clients as well, what would you like to hear from FM Nirmala Sitharaman this time around?
Well, as a financial educator, I see that one of the biggest issues that we are facing right now among individuals is the fact that the household saving rate is actually falling. And I meet a lot of people through my sessions, and what I really find is that people are saving lesser and lesser. So I think that, some of the savings instruments that are there, I think they need to increase those limits. Like, for example, NPS is a really good product for people to invest in for retirement, and they should certainly look at increasing the tax deduction that's available on NPS. And I think, the focus really needs to be on trying to see, and get people to really save more for their better financial well-being.
Okay, all right. So, encourage more savings, incentivize more savings. India is known to be a country that puts savings right on top of the financial priority. But I suppose it's once again a reminder of sorts to all Indians out there that, listen, savings should be on the top of your agenda, should continue to stay on the top of your agenda. All right, Mrin, thanks so much then for joining us in this edition of The Money Show. On that note, we will take a very short break, but when we return, we are going to be telling you how you can shield yourself, your family, your loved ones from the deadly coronavirus. Stay tuned.